Time frame is not a technical choice. It is a psychological confession. The time frame you choose reveals how much chaos you can tolerate inside your own head. Most traders say they trade short time frames because they want more opportunities. That's not true. They trade short time frames because they cannot wait. Waiting feels like weakness to an undisciplined mind. Silence feels like danger. Stillness feels like being left behind. The faster the chart, the louder the noise, and the louder the noise, the easier it is to hide from responsibility. On short time frames, there is always something happening, a candle forming, a breakout threatening, a pullback tempting. You don't have to think deeply, you just have to react. Reaction feels productive. Reaction feels powerful. Reaction feels like control. But reaction is the absence of discipline. Discipline requires space. Time creates space, and space exposes weakness. When you move to a higher time frame, something uncomfortable happens. The market goes quiet. Minutes pass. Hours pass. Nothing demands your attention. This is where most traders feel lost. They start doubting. They start forcing analysis. They start inventing reasons to enter. Not because the market is ready, but because their mind is restless. A higher time frame strips away excuses. It removes constant stimulation. It removes the illusion of urgency. Now there is no one to blame, no fast candle, no sudden spike, only you and your patience. This is why time frame is a filter. It filters emotional traders from disciplined ones. Not everyone can survive boredom. Not everyone can sit with uncertainty. Not everyone can wait without touching the mouse. The market doesn't test your strategy first. It tests your temperament. Lower time frames reward impulsive behavior in small doses, just enough to keep you hooked, just enough to make you believe you're close. Higher time frames demand commitment. You must accept fewer trades. You must accept missing moves. You must accept that your value as a trader is not measured by activity. That acceptance hurts. It bruises the ego. It challenges identity. Because many traders don't want to be right. They want to be involved. They want to feel smart. They want to feel fast. They want to feel ahead. Time frame discipline removes that comfort. It forces you to decide who you are, a participant or a professional. When you choose a higher time frame, you choose restraint. You choose delayed gratification. You choose to protect mental capital before financial capital. You stop chasing validation from the market. You stop negotiating with your rules. You begin to understand that discipline is not aggressive. It is quiet. It is boring. It is lonely, and most people cannot stand that loneliness. Time frame is not about entries. It is about who controls the decision, the market, or your impulses. The moment you slow down the chart, you slow down the mind. And the moment you slow down the mind, fear has nowhere to hide. The 5-minute chart does not train skill. It trains ego. It makes you feel involved. It makes you feel alert. It makes you feel like you're doing something important. Every small move feels personal. Every candle feels like a decision point. You begin to believe your reaction speed is your edge. That belief is dangerous. The 5-minute chart feeds the part of the mind that wants recognition. It rewards quick thinking. It celebrates being early, not being right. You start hunting trades instead of waiting for them. You start proving something instead of protecting something. Your ego wants to win now. It doesn't want to wait for structure. It doesn't want to accept uncertainty. Short time frames give ego constant fuel. Even losses feel exciting. At least something is happening. The problem is not the losses. It's what they do to your thinking. You begin adjusting rules mid-trade. You begin justifying bad entries. You begin blaming execution instead of discipline. The chart is moving fast, so your mind moves faster. There is no pause, no reflection, no space to breathe. You mistake intensity for professionalism. The 5-minute chart makes you feel smart when you predict tiny moves. It makes you feel powerful when price reacts immediately. It hides the fact that consistency is missing. Small wins inflate confidence without building stability. Small losses erode discipline without teaching patience. Your ego starts keeping score, not in risk, in wins. When that happens, you stop trading probabilities. You start trading identity. You need to be right. You need to recover losses quickly. You need to prove the last trade was an exception. This is where revenge hides, not in anger, in urgency. The 5-minute chart creates urgency by design. Every second feels important. Every hesitation feels costly. You stop asking if the trade is necessary. You start asking if you can afford to miss it. That shift changes everything. Professionals do not trade to feel alive. They trade to survive. Ego cannot survive boredom. It needs stimulation. It needs action. That is why ego loves short time frames. Higher time frames starve ego. They remove instant feedback. They delay validation. On a fast chart, you can pretend you're in control. On a slower chart, control has to be earned. The 5-minute chart allows you to hide flaws behind activity. Poor discipline disappears inside constant motion, but the account remembers everything. Every impulsive entry compounds stress. Every unnecessary trade weakens trust in yourself. Soon you're no longer following a plan. You're chasing relief. Relief from losses. Relief from doubt. Relief from silence. Ego tells you more trades. We'll fix it. Ego is always wrong. Skill grows in restraint. Clarity grows in distance. Consistency grows when the ego is uncomfortable. The 5-minute chart keeps ego comfortable, busy, engaged, distracted. And distraction is the most expensive habit a trader can develop. Patience is not the absence of action. It is the refusal to act without reason. Most traders think patience means waiting and doing nothing. That's why they hate it. They believe it makes them passive. In reality, patience is the most active position a trader can take. When you wait, you are choosing not to leak capital. You are choosing not to donate focus. You are choosing not to damage discipline. That choice is heavy. It requires strength. It demands confidence without validation. The market will test that confidence relentlessly. You will watch price move without you. You will feel the urge to chase. You will imagine profits you could have made. That imagination is painful. It feels real. It feels unfair. But those imagined profits are fantasies. They do not exist in your account. They exist only in your ego. Patience forces you to separate reality from desire. Every trader wants to feel progress. Waiting feels like stagnation. But stagnation is an illusion created by impatience. Progress in trading is invisible. It happens in restraint. It happens in decisions not taken. You don't feel discipline building. You feel discomfort. Your mind will try to escape that discomfort. It will tell you the setup is good enough. It will whisper that this time is different. That whisper has destroyed more accounts than bad strategies. When you wait, you are not being cautious. You are being precise. Precision requires standards. Standards require saying no. Most traders cannot say no to the market. They feel obligated to participate, as if watching without trading is failure. Patience breaks that belief. You begin to understand that your job is not to trade. Your job is to protect capital. Trades are optional. Survival is not. Every hour you do not trade without edge strengthens your future decisions. Every day you resist impulse sharpens your awareness. Patience slows your breathing. It steadies your perception. It reduces emotional noise. You stop seeing every move as opportunity. You start seeing most moves as traps. This shift does not feel empowering at first. It feels isolating. You are no longer part of the crowd. You are waiting while others are chasing. You are observing while others are reacting. That separation hurts the ego. It makes you question yourself. Am I missing something? Am I falling behind? Am I wasting time? These questions are part of the process. Patience is built through pain, not comfort. You learn to sit with uncertainty. You learn to trust preparation. You learn to accept that the market owes you nothing today. When the setup finally appears, there is no rush, no excitement, no desperation. There is calm recognition, because patience was not idle. It was watching, measuring, waiting for alignment. And alignment never announces itself loudly. It appears quietly. To those who are still enough to know losses are not the problem. They never were. The problem is how quickly traders try to erase them. A single loss can be absorbed. A rushed response to that loss cannot. Most traders don't fear losing money. They fear the feeling that comes after. The doubt, the shame. The quiet question of whether they know what they're doing. That feeling is uncomfortable, so they trade again. Not because the market offers opportunity, but because the mind demands relief. This is where overtrading begins, not in greed, in pain. Losses are tuition, They are information. They are the cost of learning precision. But overtrading is not education. It is panic disguised as effort. When you trade to recover, you are no longer making decisions. You are negotiating with fear. Your rules start bending. Your size starts creeping. Your patience disappears. Each trade becomes an emotional transaction. You're no longer protecting capital. You're protecting self-image. The market does not care about your self-image. A clean loss leaves your mind intact. A revenge trade fractures it. You begin doubting everything, your setup, your timing, your future. Losses accepted calmly strengthen discipline. Losses chased recklessly destroy it. The irony is brutal. Most accounts are not blown by bad strategies. They are blown by sequences. One loss, then urgency, then overexposure, then collapse. Overtrading feels like control in the moment. It feels like fighting back. But fighting the market is always expensive. Professionals understand this early. They respect the pause after a loss. They step away. They breathe. They let the emotional wave pass. That pause protects more money than any indicator. Overtrading turns normal variance into catastrophe. It multiplies risk without increasing edge. You think more trades mean more chances. In reality, it means more exposure to your weakest self. Fatigue sets in. Focus erodes. Execution degrades. You stop seeing clearly. You start reacting emotionally. Losses don't compound damage. Overtrading does. The account balance reflects behavior, not intelligence. Every unnecessary trade carries hidden costs. Mental exhaustion, reduced confidence, broken trust in your process. Once trust is damaged, discipline follows. You begin trading smaller or larger for the wrong reasons, fear or desperation. Neither leads to consistency. The market will always offer another opportunity, always. The real question is whether you will be psychologically intact when it arrives. Accepting a loss is an act of strength. Chasing it is an admission of weakness. The discipline to stop after a loss is rare, and rarity is where edges live. Overtrading is not a strategy. It is a symptom of impatience, a symptom of insecurity, a symptom of refusal to accept reality. Losses teach. Overtrading punishes. One sharpens skill. The other drains it slowly. Trade by trade, the market does nothing to you. It simply moves. It does not know your position. It does not know your stop. It does not know your hope. Yet traders speak as if it attacks them personally. They say the market tricked them, hunted them, punished them. That language reveals the real conflict. The market is neutral. Your mind is not. Price moves without emotion, without intention, without memory. Your mind brings expectation, attachment, fear. You project meaning onto random movement. You see confirmation where there is none. You see threats where there is only volatility. This projection is costly. The market does not break discipline. You do. It does not force early entries. You choose them. It does not remove stops. You move them. Responsibility is heavy. That's why most traders avoid it. Blaming the market is easier than examining behavior. It protects the ego. It delays growth. But nothing changes until ownership appears. The moment you accept that every trade is your decision, clarity sharpens. You stop arguing with price. You stop demanding fairness. You stop expecting outcomes. You begin focusing on execution. Your mind wants certainty. The market offers probability. That mismatch creates stress. Stress leads to control attempts. Control attempts lead to mistakes. You try to predict instead of prepare. You try to win instead of manage risk. The market does not reward certainty. It rewards alignment. Alignment between plan and action, between risk and tolerance, between expectation and reality. Your mind resists this alignment. It wants excitement. It wants reassurance. It wants immediate feedback. The market offers none of that consistently. When traders say the market is difficult, they mean their emotions are loud. Fear exaggerates movement. Greed distorts opportunity. Hope delays exits. None of these come from the chart. They come from within. The mind wants to interfere, to improve, to fix. But interference is rarely improvement. Most damage is self-inflicted during moments of uncertainty. A neutral market becomes dangerous only when the trader demands it behave differently. Accepting neutrality is uncomfortable. It means no one is responsible for outcomes but you. It means losses are not injustices. They are costs. Costs of participation. Costs of probability. Once you stop personalizing price, decision-making slows, breathing steadies, vision clears. You stop reacting to every fluctuation. You start respecting structure. The market does not need to make sense every moment. It needs to be respected. Your mind wants stories, narratives, reasons. Price needs none. Silence in the market exposes noise in the mind. That noise is impatience. It is insecurity. It is the need to feel right. When you quiet that noise, the market becomes simpler, not easier, clearer. The edge was never hidden in price. It was buried under emotional interpretation. The moment you stop fighting the market, you face the real opponent, your impulses, your expectations, your need for control. And that opponent never takes a day off. Professionals do not wait because they are patient by nature. They wait because they've been burned. Every pause is paid for with loss. Every hesitation is backed by memory. They remember what happens when discipline breaks. They remember how fast confidence collapses. They remember how expensive impatience becomes. Waiting is not theory to them. It is survival behavior. Early in the journey, everyone believes they are different, smarter, faster, more intuitive. That belief doesn't last long in the market. Experience strips it away brutally. A few reckless wins create false confidence, a few unmanaged losses. Expose reality. Professionals learn through damage, not books, not advice. They learn what overconfidence feels like. They learn what chasing feels like. They learn what ignoring risk costs. Each mistake leaves a mark. Over time, those marks form restraint. They stop forcing trades not because they don't see setups, but because they've seen what happens when they force them. They've experienced the spiral, one bad entry, then justification, then size increase, then silence. That silence after damage is unforgettable. It teaches respect faster than any mentor. Professionals wait because they know how fragile clarity is. One emotional decision can poison the next 10. They've learned that discipline is not permanent. It must be protected. Waiting protects it. They understand that the market will always be there, but mental capital might not. So they step back. They let price pass. They let opportunity go. That sacrifice hurts. It triggers memories of past mistakes. But those memories guide behavior now. Professionals don't chase because they've chased before. They don't revenge trade because they know the feeling too well. They don't need constant action to feel productive. They've paid enough to learn that lesson. Waiting becomes a skill earned through pain. It rewires instinct. Instead of reacting, they assess. Instead of guessing, they measure. They've learned that boredom is cheaper than regret. They accept being wrong slowly rather than catastrophically. Professionals don't believe in perfect timing. They believe in acceptable risk. They don't enter because something might happen. They enter because risk is controlled. That understanding comes from loss. Loss teaches boundaries. It teaches humility. It teaches respect for uncertainty. Waiting is not hesitation. It is caution informed by memory. It is the discipline of someone who knows what happens when discipline disappears. Every time they do nothing, they are choosing not to repeat old mistakes, not because they fear the market, but because they understand themselves. Experience teaches that the most dangerous trader is the confident, impatient one. Professionals were once the trader. They survived by slowing down, and slowing down is the only reason they are still here. Innate uncertainty, but to operate comfortably within it. When you accept that outcomes are random, but execution is not, you gain control where it actually matters. That understanding separates professionals from hopeful participants. Discipline becomes most powerful when no one is watching. It is easy to follow rules after a win, and hard to follow them after a loss. That is when discipline matters most. The market tests you not when you feel confident, but when you feel discouraged. It watches how you behave when things are not going your way. Those moments define your future results. Eventually, you stop measuring success by daily profit and start measuring it by consistency of behavior. Did you wait for your setup? Did you respect your stop? Did you walk away when conditions were unclear? Those questions matter more than any number on your screen. Money follows behavior. It never leads it. There will be days when the market moves beautifully without you. Those days are lessons in patience. There will be days when you do everything right and still lose. Those days teach humility. Both are necessary. Both shape you. Trading is not just a technical skill. It is a personal evolution. The 5-minute chart does not forgive shortcuts. It exposes dishonesty instantly. You cannot pretend to be disciplined here. You either are or you pay for it. That honesty is its greatest gift. If you can remain calm, structured, and detached in this environment, you can handle any market pressure. Over time, you stop feeling the need to prove anything. You do not need to win today. You do not need revenge. You do not need excitement. You only need alignment. When it appears, you act. When it does not, you wait. That simplicity is the final stage of mastery. In the end, trading becomes quiet. No drama. No rush. Just preparation, execution, and review. The market becomes a place of observation, not struggle. You respect it, and in return, it allows you to participate. That is when you understand the truth most never reach. The 5-minute strategy that always works was never about entries or exits. It was about becoming the kind of person who can execute them correctly under pressure. When you master that, results follow naturally. This is where the journey ends, and where real trading begins.